Okay, folks, and welcome to another Sunday Night Futures Live. It's very exciting to begin this abbreviated week. Remember, abbreviated week this week, 4th of July. God bless America. Never forget that. I'm very excited to be here, and I hope everybody had an awesome weekend. My daughter just got back from Europe after being there for 3 months, and it's great to have her home. Did some cooking tonight, spent a little bit of time by the pool, and uh, psyched. Looking forward to the new week. Okay, so we have the futures market open. I'm just watching it settle down here. You're looking at the E-minis, S&P 500. What I wanted to spend some time on tonight is the closing price action, because remember, only one trading day left to go in the month. I want to talk about the monthly charts. I also want to go over the high-level view, really high-level view of the big, beautiful bill. I'll be frank with you, I'm highly torn on it. There are provisions that I do like because they're self-serving, but I understand why others in other areas of the country that are not as high tax as I am do really respect their opinion. So we're going to touch upon all of that. But first, of course, we're going to do what we always do. We go over the futures. But before we do that, let's say hello to our friends out there. And Lee Cable. Lost you there for a second. There he is. Good evening to you, sir. Talon. Listening in from Colorado Springs. What are you doing in Colorado Springs? Look at you. Living the life of leisure. Sean, welcome. Mr. Pete, welcome. Larry, welcome back. Bob, how was Bezos' wedding? I got kicked out again. Every time I go to a Bezos function, I get kicked out. They asked me to leave, and not in a nice way. Okay, so here we are with the S&P 500 or the E-minis opening up 0.09%. This is a 15-minute chart. Let's pull back a little bit. Let's go to a 5-minute view. Bonnie Bean, welcome. From Southern Ontario, Canada, welcome. Our friends to the north. Okay. So a solid open here, up about a tenth of a percent. Let's take a look at the NASDAQ. Really quiet headline weekend, which is why I wanted to do the monthly charts. There was really not a lot to talk about, with the exception of the tax bill or spending bill, if you will, that is coming through the Senate. I believe it's been voted on by the Senate. We have the NASDAQ 100 up 0.15%. Solid open here. Lee Cable, I was just there. What part of the UK? Not that I was all over the place and I would know it. I was just in London and down into Ireland. But I really enjoyed my time there. Really did. And it was sunny. I was told in both Ireland and in the UK that they never saw a stretch of weather like they had while I was there. I didn't feel a drop of rain for 9 days. Not one drop of rain, which I believe is unheard of in that area of the world. My niece is marrying the first guy she met in college. Seems like a good decision. Awesome. Congratulations. God bless them. May they have a wonderful life. Let's check in with the Russell 2000. The Russell 2000 up 0.15%. The thing I want to point out with the Russell 2000 is that generally 6 months after the first rate cut, the Russell 2000 tends to outperform. We're going to be going over a monthly chart of the Russell 2000. We're beyond that 6-month mark now. But I think that the Russell 2000, if yields continue lower, that's the caveat. You need to have the regional banks move up higher. They did it last week. You also need the biotechs. The biotechs need to move up higher. They did okay last week, not great, consolidated nicely. It looks as though they're going to move up higher. I think that the Russell 2000 is becoming an interesting play, especially if you believe that there are going to be interest rate cuts. Portsmouth along the South Coast. Okay. I'm not familiar. So you'll have to forgive me for that. But I know the name. George, welcome. Yeah, I had a great time. Great time. I mean, the history in the UK is just incredible. It's really, I spent a lot of time over at the British Museum. Just incredible, the history there. I stayed at the Tower Bridge Hotel overlooking the Tower Bridge. Awesome. Beautiful. Absolutely beautiful. Let's check in with the mid caps, which should trade along with the small caps. They're actually down. Let's go back to the mid cap or small caps for a second. Interesting. How's our volume? Thin. Strange that everything else is up. Mid caps are off their lows. They may press up higher here. Just maybe light volume. Let's check in with volatility. Volatility down over 1/3%. So the gapping vol down. It's hot as heck here in New York. Trying to stay hydrated. Let's check in with bond yields. Bond yields moving up. Wow. This is a pretty big move here. On the 10-year yield, this is not what the markets want to see. This is actually a new contract, to be fair. Sometimes it's skewed from the prior contract. We'll give it a pass right now, but it is showing as up relative to the close on Friday. Let's take a look at the US dollar and how it's responding to the rise in yields. The dollar is down, gap lower, very weak. So who's benefiting? In the currency world, euro. Euro had a really great week last week. The dollar looked as though we were going to go into the new trading week very strong. I expected a pullback to a support level, perhaps a retest. That retest did not hold. It broke that support level. So the dollar is in trouble here, especially if that tax bill gets passed, because that just means, God, I mean, that's $2 trillion per year in deficit spending. It's $5 trillion in a debt ceiling that they want to avoid in August. So you could bet that this year there's going to be a lot of liquidity out there. That means that you could quite possibly see a lot of inflation as well. We'll talk more about that in a moment. I don't want to get ahead of ourselves. Japanese yen opening up yet off the hot session highs. Let's check in with commodities. Gold opening lower by 0.16%. You can see we've established a bit of a downtrend here. In purple, that's your upper band of resistance. I don't see a reason to go buying gold right now. I think there will be a time, and we're currently long. I'm not selling right now. And you're going to get counter trend rallies. You just got to wait for the breakout. And we may get a counter trend rally fairly soon. I mean, we're probing the lower band of this downtrend channel on a 4-hour time frame. So I wouldn't be the least bit surprised to see 32.50 and then watch for a rally off of that support level. Looking at silver. So wow, silver's taking it on the chin this evening. This is actually Thursday was the new contract for silver. Opening down, trading below the 21 period EMA in orange. Light sweet crude opening down. Wow. Big move lower here at the open. Light sweet crude had a major reversal. Remember, the past couple of weeks, we kicked off Sunday Night Futures Live with oil being our first chart that we watched because it was the tail that wagged the stock market dog because of all the headline risk out there. Now the risk premium has come out of oil. And I always warn it is don't chase these stocks on headline news or commodities on headline news because once that headline is gone, they revert to the mean, if not low. And right now, oil is trading lower now than before the crisis with Iran erupted. So not good for longs of oil. Let's take a look at natural gas. Natural gas opening down with a gap lower of 1.5%. That sounds like a lot, but for natural gas, it's really not much of a move. I call it the widowmaker of commodities because it's just so volatile. So I wouldn't be the least bit surprised to see that we're trading up tomorrow morning. Sounds crazy, but true. TZ Burton, you changed your icon. Digging it. Zoot suit type thing. I like it. Good evening to you, sir. Let's take a look at other commodity names. Let's go to the food space. LE, live cattle. Live cattle at all-time highs. Let me validate that. No, it's not at all-time highs. I'm glad I went to the weekly chart. It looks like it's going to go retest all-time highs. Huge week last week. A bullish reversal bar on the week. Herd stocks here in the United States are at levels not seen since 1965. Crazy. Corey, welcome. OG1, welcome. OG1, please use the if you would, so I don't forget it. Here, I'll put out that link. I won't remember it, and I'm not going to be able to go through all of these messages to find them. And we have a brand new process that's going to be coming out fairly soon. The lovely Jody, welcome. Okay. Live cattle looking really good. Let's go back to the weekly chart. Let's take a look at ag. Wheat prices, bearish reversal bar last week. Corn, horrible week last week. And ZS, soybeans, agriculture not looking good here at all. Just stuck in a trading range. I'll tell you right now, it looks as though soybeans is either going to have a massive breakout or a breakdown with this Bollinger Band squeeze firing off. It looks like it may fire off down. The reason I say that is that we had a failed breakout. and we closed down the week below the prior 3 weeks, 4 weeks. If you want to go 5, I can go back 6 weeks here, and below the 21 period EMA. Not looking good. Could be a liquidity hunt. I'm going to create an alert here because if it is a liquidity hunt, if they're blowing out stops, that means they're going to take this thing up very, very rapidly. But that's pure speculation. What else do we have here that's interesting? I think we covered it all. You know what? Not copper. Copper's been interesting. This is this week. This is last week here. Beautiful price action last week. It looks as though copper wants to go up higher, bullish. Okay, let's take a look at what's going on in the world this coming week. Oh, is it this one? Yeah. All right, before we kick it off, TrendSpider, they're having a 50%, up to 50% off sale for 4th of July. Use the link below on YouTube, link above on Facebook and Twitter, X, and take advantage of that. Help support the channel if you would. All right, economic data coming out this week. We have on Monday, not much happening. We have the PMI out of Chicago. Tuesday, S&P 500 manufacturing PMI for June. Construction spending, job openings. That's an interesting number. You're going to want to watch that one. ISM. The reason why you're going to want to watch that one, because that could move the Fed needle. Will they cut rates sooner? Will they have to wait? If you see job openings decline, that's a problem. That means a slowing down of the economy. ISM manufacturing coming out as well. Auto sales, we have big problems again in the used car market. On Wednesday, we get ADP report. That is the jobs report out of ADP. That's the precursor to Friday's Pimp Mac Daddy of them all non-farm payrolls. But before we go there, we're going to get initial jobless claims on Thursday. We're going to get the unemployment rate. Actually, I'm sorry. They're going to release non-farm payrolls a day early. That's right. Abbreviated week, Bob. So they're expecting 115,000 new jobs. That's not a lot. It's a very low threshold. So a big week in terms of economic data. The one thing I will say is that volume is going to drop off this week quite a bit. So just be careful. Don't interpret too much into a move in any one stock, into any one index, unless you are watching the volume. If volume is very, very light, don't get antsy if it's up. Don't get excited if it's down. Just relax. Watch the volume and stick with the overall trend. Earnings this week, I mean, there's not much to talk about. Nothing happening here. In terms of Fed Watch Tool, the probability of the Federal Reserve. Last week, we saw an increase in the probability of the Federal Reserve cutting rates to about 24% probability in the month of July. That is now pulling back. What is still holding strong is the probability of a cut in September at 92.5%, October 97.4%. So September is looking pretty good. We'll see whether or not there's anything that could derail that. Now, I'll tell you right now, one thing that the Fed chief is not doing for the president is helping him out in any form or fashion. I thought there might be the beginning. What you're looking at here is the Federal Reserve's balance sheet. For illustrative purposes, where has this balance sheet been? Well, prior to 2008, before the financial crisis, it drifted up a little bit, not even above $1 trillion. All that changed after the financial crisis when we went to quantitative easing. Basically, yield curve control, the Federal Reserve buying longer dated debt, mortgage-backed securities, increasing their balance sheet, which they're really not supposed to be doing, but they got the blessing from Congress and they did it anyway. So we have seen the Fed's balance sheet go from $800 billion prior to 2008 up to about $9 trillion. We are now back down to $6.6 trillion. It appeared as though right here that we may get higher highs from the Federal Reserve. But I think that every time the president tweets or uses Truth Social to bash the Fed chairman, I think that he intentionally dumps more bonds on the market just to stick it to him. To be honest with you, I really do. So the Federal Reserve's balance sheet, which appeared as though it was stabilizing, they may begin to buy back some debt. The president and the Fed chair had a meeting. Maybe they did a little bit of nice talk. Nope, ain't happening. I think it's still speculative that you're going to get a rate cut in September. I'm very surprised to see that everybody's so optimistic about it. What are they worried about? The jobs data this week may be an indicator of what they are in fact worried about. That's just speculation. We know that leading economic indicators are weakening. As for valuations in the market, the trailing multiple for the S&P 500, 37.65. Very expensive. And the Buffett indicator is overvalued. We are off the highs, but we are still very, very extended beyond the historical trend line, which we haven't seen for years, not since 2016, around there. Long time. We're due. Consensus earnings growth this is out of Goldman Sachs, for 2025 SPX growth forecast down to 7%. NASDAQ 100, 14%. Interesting here is the Russell 2000. I mentioned this earlier. The Russell 2000, they have gone from a negative growth rate in 2024, now expecting a positive growth rate in 2025 to 18% and 37% in 2026. So I think it's time that we begin to look at, if you believe the fact that the Federal Reserve is going to cut rates, you need to be looking at the small caps. But be very, very careful if you see the regional banks and the biotech stocks fall. Be careful because the Russell 2000 is overweight of those names. They must move up higher, or the Russell 2000 struggles to remain stable. Now, one of the reasons why we're seeing the rally that we are, besides the headlines becoming more friendly to equity holders, is that liquidity, while not at all-time highs, liquidity is quite favorable. There's a lot of money sloshing around out there. There's only one problem with that. That's inflationary, and inflation can appear in the equity markets. So we're seeing liquidity skyrocket, stocks all-time highs, and we're making these all-time highs with a multiple at 36.65. I mean, it's kind of bananas that we're doing this. It makes getting long of this market like ice skating on very, very thin ice. You know, you get a series of bad economic data coming out. It may not bode well for equities in the short term or to the intermediate term. So we need to be very, very careful. All right, so over the weekend, Senate advances Trump tax and spending bill in Saturday night vote. 1,000 pages. Elon Musk out. Polls show that this is political suicide for the Republican Party. And he's made other statements to the fact that it will lose about 1.5 million jobs, if not more. So what's Elon's problem with this bill? And I punched some queries into ChatGPT, and I want to keep this very high level. So I just wanted the top pros and cons for the tax bill, extended tax cuts, and business incentives. Business incentives, that's good stuff. We always want that. Lower rates for corporations, research and development deductions, that's good stuff. I like that. Consumer tax relief, I'm good with that. I can have a very, very long conversation about this. This is very inflationary, highly inflationary, because you have people that are earning tips that they need that money to spend immediately. They're not going to invest. I shouldn't be so general, but by and large, those folks are going to spend that money into the economy quickly. That's good for GDP. The problem is that's also bad for inflation, because inflation is going to go up. You're going to have more money chasing too few goods. We've seen this before. Overtime, increased standard deductions, etc. Okay, so if you're this is a multi-tiered problem here. If you are a employee that is working hourly and you're making overtime and you're going to get a tax break, well, that's great. It's good for you. I'm glad. Congratulations. Happy for you. What about the salaried worker? What about that salaried guy that could quite very well at certain times of the year be making less than the guy that's working hourly? So might there be pressure on salaried workers as well to balance out the wage spectrum? So to me, while I hate taxes, I think you can see how they get spent. Wars. We buy wars. That's what we do. Uh, that's not good. It's not a good use of our capital. But since they're going to take it anyway, we got to keep in mind that there is uh, a cause and effect. So if they do this, that means that you're going to see wage pressures to the upside across the spectrum. What might that lead to? Layoffs. And if it doesn't, it could lead to more inflation. Uh, Direct stimulus to households. I think that what I'm interpreting into this is that this is the beginning of a change from Social Security to something new. This money is going to be able to go into the stock market. Now, think about it. The day you're born, you get $1,000 put into the S&P 500. You're 18 years old. That's a good hunk of money. Suppose you can't take that out until you're 65 years old. If you've been contributing to it or in an additional account, well, then you're probably doing a lot better off than if you were taxed on Social Security and you're getting a pittance for what you've already invested in it. So I kind of like this. It sounds like a giveaway, but if it's a transition away from Social Security, I'm all for it. And I'm talking, this is going to be a decades-long process. It's not going to be an overnight thing. Defense and industrial winners, a proposed $150 billion boost in defense, especially military tech and drones. You got to start looking at these defense plays. The defense stocks over in Europe are rip-roaring hot right now. Market-friendly sentiment, I don't really care about what these banksters have to say. It really doesn't matter to me. The cons, rising deficit and debt concerns. So the Standard & Poor's was the first ratings agency to downgrade our debt. That was in 2011. You know what our debt was back in 2011 relative to now? An anthill versus this mountain. So they're due to come out and be the next to downgrade our debt, if not Fitch. Higher interest rates. Yeah. I'm rather surprised to see that the markets are anticipating a Federal Reserve rate cut when you're about to unleash about $5 trillion worth of additional spending that could be done this year before the next debt ceiling debate between the Republicans and the Democrats. Renewable energy and clean energy hit. I think this is one of the issues that Elon has a problem with. I've heard him say before the election that he had no problem with getting rid of the incentives for EV vehicles, but I think he's worried about other industries in that they're favoring the old industries of yesteryear relative to favoring the new and upcoming industries. And he could be quite right about it. I don't know enough. I need to do more research. Foreign investment risk. Yeah, well, it's simple. Higher the debt here, the greater the risk that we default. Simple as that. Potential market volatility. Analysts warns of a bubble-like conditions driven by capital flowing into speculative tech, AI, memes. I think we've already been there. We are there. Just look at the valuations. I mean, I can only go to this chart only so many times. Overvalued here. We're just shy of a 40 handle on the S&P 500. I mean, it's bananas. So, kind of nuts. So let's go to the monthly charts here. I think we did enough. Did I miss anything? This is just a chart of the US dollar and how it's really weakening up here. And we're seeing it open lower at current. And I think it's only going to get worse here for the US dollar, unfortunately. And it all goes back to if we are an import reliant nation, which we are, and the US dollar is going down, is that inflationary or deflationary? It's obviously inflationary because it's going to take more US dollars to buy those foreign goods. So foreign goods, unless they're going to eat the margins, eat the spread on their margins, which I doubt. They're eating, the Chinese are already eating tariffs. I don't know how much more they're going to be able to eat to basically subsidize America, which is frankly going bankrupt. I hate to say it, but it's the reality. So, Peter Schiff calls it vendor financing of the United States. And if you think about it, he's not that far off. All right, let's take a look at the monthly charts here. Scott McCullough, good show. Thank you, sir. I appreciate that. Hope the Treasury does a QE3 and buys mortgage-backed securities to make some real damage. They're probably going to have to at some point in time. I don't think it's going to be under Powell. I think that what may happen here is if they cut rates, let's bring up the yield curve. Let's go to the monthly charts. Let's talk about this. Okay, so let's say that the Federal Reserve cuts rates. They usually, right now, we don't have pressure on jobs. We have wage pressure already going up. Yes, we have leading economic indicators coming in and threatening a weaker economy. I won't deny you that. But it's not horrific. We're still seeing GDP growth. It's still there. It's still happening. Rarely is the Federal Reserve proactive. It's always reactive. So do I expect the Federal Reserve to act anytime soon in advance of a threat? No. I've never seen a time where they've done that. It's always they deny that there's a problem. Then when the problem hits, what do? They come riding in on a white horse in shining armor. But it's the problem that they caused. They're the firemen coming in, but they're the arsonists that set the fire in the first place. They've been doing this since, hell, I want to say 2008. It's even before that. It goes back to Alan Greenspan. So here we are going into the new trading month. 1 day left to go. A lot can happen. I always want to say that. But I want you to take a look here, folks. This is a monthly chart of the yield curve. This is not necessarily the one I want. Let's go to the one I want. 30-year view. This will bring in a couple of other bubbles of yesteryear. XLP looks like death here. These are all overlays of correlations. XLP, that's Staples, TLT. Remember, Staples, when you had equities going down a few months ago in April, March, April, the only sector that was really moving up was equity sector, was Staples and the gold stocks, etc. But they're now rolling over where the bonds are beginning to firm up here a little bit. I wouldn't call this getting ready to break out. I'm just saying they're firming up. I wouldn't be the least bit surprised to see the bottom drop out here. Natural gas, that was doing very well. Gold was doing very well. S&P, while we were going down, it was gold, natural gas, staples that were doing well. Not the US dollar and not bonds. Usually when you have equities go down in times gone by, bonds go up, dollar goes up because that's a safe haven. And that wasn't the case this last time around. You want to talk about a glimpse of what a new bubble could look like? It ain't pretty. Lee Cable, this is a controlled demolition by the Fed. Well, yeah, we can all go down a real serious rabbit hole here. It's not just the U.S. Federal Reserve. You know, you have the Bank of International Settlements. You have banks out there, central banks that aren't even central banks of sovereign nations. You have the Bank of International Settlements, which has immunity for everything. There has no oversight of the Bank of International Settlements. And many people are out there right now saying, I don't know what you're talking about. Exactly right. But they're as if a sovereign entity, and guess who owns them, or guess who's a part of them? Every major central bank in the world, plus the commercial banks. Yet you have no say in them, and that's your money. Look it up. Michael Anthony, CLV. All right. Enter that symbol. We'll go over for you, pal. TC Burton, Bob, isn't that 1,000 per kid coming straight from the Fed? Won't that lead to a newborn straight CBDC? I don't know the mechanics of it. Well, it would. So to answer your question, it would have to come from the Federal Reserve. Well, it doesn't have to. We do get revenues from taxes and tariffs now. Does it come from the Federal Reserve? If it's explicit in law, I guess it would. But right now, the Federal Reserve is running at a loss. Any surplus by the Federal Reserve is to be paid to the U.S. government. They're running at a loss right now. They haven't had a remittance to the federal government at last look for, I don't know, several quarters now, a couple of years now. So I don't know if it'd be coming from the Federal Reserve. They could certainly be printing the dollars to create that money. I won't lie to you there. But I doubt it's written in the law that way. Do they want CBDCs? Yeah, they do, because everybody's bankrupt and they want to come pick our pockets. They don't want you to be able to hold back your money in your bank account because you're worried about inflation and paying your bills. They want to be able to go in and say, okay, if you don't spend this money by XYZ date, you're going to lose it. It expires worthless. That's what they want. That's the value of the CBDC. It's to hijack your bank account. It's moving forward in Europe. It's moving forward. When I was in England, I couldn't find many places to pay cash. And the hotel I stayed in, zero cash. No cash whatsoever. I tried to tip people. I tried to break some higher denomination euros. I couldn't get cash to pay the guy who was bringing up food to my room. Couldn't do it. Gold to AK by 2030, certainly possible. The minute they go to quantitative easing, gold is just going to skyrocket higher. All right, so back to the yield curve. So the yield curve we haven't spoken about much, But one of the values of waiting to the end of the month is to see how the month played out. Early on in the month, the yield curve, which is the spread between 2-year treasuries and 10-year treasuries, their yield. So early in the month, we put in new lower lows versus the prior month. By the end of business on Friday, we had turned positive on the month with a bullish key reversal. So how I look at this as a technician is that we are going up, steepening. This is not bullish for equities. It doesn't make it necessarily bearish for equities right away. In fact, we reversed to close positive on the month, yet we put in new all-time highs, not all-time highs in the S&P, but all-time highs on the triple Qs. So the yield curve is threatening in a very big way. And for those not familiar, these lines here represent times in the past where you've had a yield curve blowout, and 2000, that's the dot-com bubble, the financial crisis here, COVID here. And right now, we're calling this the everything bubble. Everything. And you're already seeing the steam come out of it. The dollar, weaker. Bonds, weaker. Everything. The most important asset classes for the average American are declining. They are at very, very close to 52-week lows. The U.S. dollar and the U.S. bond market. The CRB Commodity Index, monthly view. Now, if you took a look at the weekly view last week, it was a horrible, horrible candlestick. Really, really bad stuff. But you take a look at it on a weekly view, you got to take a look and say, okay, we have one trading day left to go. Granted, we have in the pre-markets already, we have oil down, natural gas down. Oil was destroyed last week. But still, the CRB Commodity Index put in new monthly higher highs relative to April and May. So new monthly higher highs threatened to break out. Then we got rejected last week. So can we break out here in the month of July? Absolutely. It's absolutely possible. It's not as probable as it was this time last week, but it's certainly a threat. And if you start seeing the CRB Commodity Index rip-roaring to new multi-year highs, you're going to go back to that FedWatch tool, which showed a 92% cut rate probability in September. That's going to drop like a rock. Because this in and of itself is the very definition of inflation. Bond yields. So on the month, at current, again, one trading day left to go, we have broken monthly support at one point. We're holding another point. But I do want to take you to this chart here, just as a reminder of where we're at on a macro view. Where's my chart? Let's go to a yearly chart. This is not a bearish chart. Granted, right now on the year, we are down, but we have broken out of a major, major downtrend channel here. So if anything, we are in an uptrend channel on the 10-year. This is the 10-year yield. So let's not get lured in by a down month or two on the 10-year yield. The macro trend, which is what we always want to know, where have we been to identify where we might be going? We always want to look at the macro view, and the trend is clear, it's defined, it's up on yields. As for bond prices, I mean, this is the TLT, this is the 20-year bond, and we are struggling here. We're at the lower band of a multi-year now trading range. I'm not going to be the least bit surprised to see a move up to the upper band, but I'm not going to be the least bit surprised to see a break of the lower band if this bill is passed. I have to say, I'm very concerned about this spending bill. The one benefit for me, and I alluded to this earlier, is that I live in a very, very high tax state. And when the first tax cut by Trump was put in 2016, 2017, his first term, my taxes didn't go down. They went up because of the SALT deductions. They capped my property tax and mortgage deductions for interest at $10,000. My property taxes alone are above $10,000 easily. So it really hurt, the removal of that deduction and being under the alternative minimum tax. It's been hell these past few years. So for me, the moratorium, it's not permanent. It's about a 5-year moratorium. It goes up to $40,000 per year. And that's going to help quite a bit. But that goes away after 5 years. So that's the only benefit that I see for me in this tax bill. Otherwise, I see problems. I see a lot of problems with it, unless there is something in that bill that helps business to grow GDP. If we grow GDP, then we can begin to outpace the rate of our debt growth. But it doesn't appear that that's the case anytime soon. That's a problem. Okay. Treasury inflation protected securities. I look at this chart here. This is relative to gold. This is a very bullish chart. You're not going to want to buy tips if you don't expect inflation to move up higher. We are now in a 4-month trading range. We have a reversal month. It appears as though we're going to go higher, and it's usually the big money that buys tips. So what is this chart telling us? It's telling us that there's probably going to be more inflation because the smart money out there is buying up tips. This mom and pop really don't buy tips. It's big institutions that buy up tips. Bitcoin. Let's refresh. This is off the highs. It's bounced back here now. So Bitcoin is very strong. The correlation to equities over the past few months has clearly decoupled. They were highly correlated. Equities went down. Bitcoin did very well. We broke out of a massive bull flag setup, and it looks as though we're going to go higher on Bitcoin in the coming months. The dollar, train wreck. This is an absolute train wreck. This in and of itself is inflationary. I already just talked about it earlier, but train wreck, volatility, train wreck. To me, it appears as though you have a lot of money supply out there that's going to continue to flow into equities, unless, of course, we get a gap up on July 1 and we hold that gap up. If we make a new monthly lower low, we're probably going to come down to a 15 handle on volatility. That means new all-time highs for the S&P 500. The Dow transports surging this month 5.5%. That's a big move for the Dow transports. The question is this a bear market rally? We don't know. Let's take our crayon out. We still have, we're right there. We're right there. We're flirting with a monthly breakout. Not there yet on the Dow transports. Now, when do things get real fast for the equity market? If we fail to break out and the Dow transports break 12,470, that's a confirmation breakdown on the Dow transports. Not wonderful. So this chart here is the Dow Jones U.S. Containers and Packaging Index. So this is one of my indicators I look at. If you have the Dow Transports moving up higher, the Dow Jones, S&P 500 moving up higher, is it a sign of economic growth, or is it simply speculative money rotating into equities? Well, one of the things I like to look at is U.S., Dow Jones U.S., United States Containers and Packaging Index. One would think that you would have a direct correlation between manufacturing, transportation, and containers and packaging. We don't have that. We're down on the month. Something to think about. S&P 500 monthly chart, we had broken down below monthly support. New all-time highs. On pretty decent volume, to be fair. The Dow Jones Industrial Average monthly chart recaptured support after breaking down. Very, very bullish. Volume, bullish, above average. Triple Q's monthly view, new all-time highs. Who would have thunk it 2 months ago? Volume, below average. IWM, small caps, surging here, up 5.37%. If yields pull back, if regional banks move up higher along with the biotechs, I think you got to start buying small caps. The banks, I think they're going up higher. There's a lot of goodies in this tax bill for the banks. They're going to be rolling back some financial crisis era Dodd-Frank legislation. They're going to be easing up on the ability of banks to buy treasuries. That's self-serving. They're going to want the banks to help finance the debt that we have here. So good for the federal government. Maybe not so good for the banks if they get too overweight of our treasuries. Technology, new all-time record highs. Horrible volume. Horrible volume. Let's bring up the semis. I don't know why I don't have them up here as a default. Semis. Close to all-time highs on weak volume. Discretionary names, monthly chart. Up month, volume below average. Energy stocks, up nearly 5.5% on the month. Both lines on Stokes, trading down below 50. Rallies usually tend to fade. What happened this month? We're fading off the highs of the month. However, we still remain up. Respectable month still. Just be careful with the momentum is not good here at all on energy stock. Where's light sweet crude? Let's bring up light sweet crude. I had it up here earlier. I know I did. Okay, monthly chart, light sweet crude. Look at that reversal bar. Very weak price action. Yes, we're up on the month by 7%, but that's horrible, horrible price action. Is it knee-jerk reaction to the settlement, if you will, of the Iran-Israeli matter, war? Yeah, sure. Sure, knee-jerk reaction. Moving on to emerging markets. This is emerging markets, EEM with China, up 6.67%. I think that this is the place to be. I'm not necessarily passionate about mainland China. EEM, most emerging market funds are 30% China. If you don't want that exposure, look at, this is what we own, EMXC up 7.5%. Brazil, up 10% on the month. And a lot of room to run here. So do I want to be in emerging markets or U.S. stocks? Give me emerging markets. I think we have a lot more upside there. Utilities attempted to break out. If yields break down, utilities will move up higher. Gold now down on the month. No new closing high for the past couple of months. Looks like we're pausing here. Silver attempted breakout. Well, we do have a breakout on silver. Guys, I'm going to have to pause it here. I have a crisis that just arose I'm being notified of, and I got to attend to it. Have a great night and a profitable trading week. Members, I will go to your chart requests on Monday. Okay? Sorry about that. I got to cut out. Be well. Have